the multiple choice questions in the back of the book. We'll start with those, then we have a couple problems we're doing. I have the answers highlighted here. I'm going to do it a little bit different this week, but I want to show you how we got there, how we did it. So, it says consider the following information. Ending inventory, 24,000. Sales, 250,000. Beginning inventory, 300,000 or 30,000. SG&A, 70,000. Purchases of inventory, 90,000. They want to know what is our cost of goods sold. So, if we look at the inventory equation, right? We have our beginning plus our purchases minus our cost of goods sold gives us our ending, right? So when we look at the relevant numbers, we're only looking at inventory numbers here. We're trying to solve right here for this guy, cost of goods sold. So that's why I put a check mark next to the relevant item. So ending inventory, we know, is 24. Beginning inventory, we know, is 30. Looks like we purchased 90. What that means here is 30 plus 90 minus 24. X equals 96. That's our cost of goods sold. There we go, number one. Number two, the inventory costing method selected by a company will affect, well, the balance sheet, right? We have inventory, that's an asset that's on the balance sheet, so that's true. The income statement, we're dealing with cost of goods sold, which is an expense, so that's true. And then, hey, we know our statement of retained earnings, right? Beginning plus net income minus dividends equals ending. Well, if we have net income, which is our revenue minus our expenses, cost of goods sold is an expense. So it will affect the statement of retained earnings. So that's why it's D, all of the above. 3 says, hey, which of the following is not a component of the cost of manufactured inventory? So manufactured, we said, hey, these are the people who make the inventory. Definitionally, we know that's our raw material, our factory overhead, direct labor. It's going to be A, administrative overhead. Not as concerned about, like I said, that manufacturing inventory for the exam. That's more of a cost accounting class. What they're doing here is just laying the framework for when you get into that class, that you know that, hey, we have to have separate inventory for them. They're people who manufacture the inventory. Number 4 here, let's look at this. Let's just erase this so when we read it. So what they want us to do here is they're saying FIFO, and they want cost of goods sold. So they want to know what cost of goods sold is under FIFO. So it looks like our beginning inventory, we had some beginning, we had a purchase, we had a second purchase, and then we sold. And what we did here, our beginning were 10 units. We then purchased 35. We then purchased 40. And we sold 50. Running out of colors here. So 10, we're at 20 bucks. 35, we're at 22. 40, we're at 24. So that's like, I just took a bag of Skittles and I threw them on the screen there, right? I got like every color under the sun. Let's map this out. So we started 10 units at $20 a unit. Then we bought 35 at $22 a unit. Then we bought 40 at $24 a unit. And then we know we sold 50. So what they want us to do is figure out, quantify cost of goods sold for these 50 units we sold using Fifo. Now we know with Fifo, right, our first in or our first out. So what that means is we start from our oldest inventory and work our way down. We know Lifo is the reverse. We start our last in, so you can think first place, second place, third place. So Lifo, our last in, last place, we start down there. Fifo, our first place, we start up here. Work our way down, work our way up. They want to know it for Fifo. So what we're going to do here for Fifo and what they're asking for is cost of goods sold. So for Fifo, our first in, our first out, and we have to get rid of 50 units here. So we got to cross off 50, take them out. So we're going to take 10 from the first batch, 10 units. Looks like those cost us $20. Well, we have, this is all taken care of. Then we're going to take all 35 from the second batch. Those cost us $22 a unit, so 10 and 35. So that's 45. What that means is we sold 50, we've taken care of 45 of them. We got to get rid of the remaining 5. So we're going to take it from this batch down here. We started up here, worked our way down. 5 units at 24. So what we do is simply cross multiply. So $200. Let's see here, 35. So I think that's 770. And then 120. Add all of these together. 200, 770 plus 120. 1090 is our cost of goods sold. So that's how we got that there. We were using Fifo. We started from the top, worked our way down. The next question here essentially is the same exact facts. So these right here are the facts. This is applying Fifo to the facts. Now they're saying, hey, can you please calculate, based off those same facts, cost of goods sold with Lifo? So hey, we got to do Lifo here. So we're going to work from the bottom up. We sold 50 units that we got to take care of. So what we're going to do here is we're going to take 40 from the bottom batch, our third place batch. Those cost us $24 each. So that's $960. We had 50 we got to take care of. We took care of 40, so that means 10 that were taken from this second batch. That cost us $22 each. So that's going to be $220. Add these together, $1180. So that's cost of goods sold under Lifo. We're going to do another problem similar to that in the remaining problems, but that's a good refresher showing, building on what we did in class. 6 here, so essentially this is saying, hey, an increasing inventory turnover ratio. So first off, what is the inventory turnover ratio? It's going to be your cost of goods sold over your average inventory. What essentially this is showing here when we have an increasing inventory turnover ratio is a shorter time span between the purchase and sale of inventory. Essentially, what this inventory turnover ratio is measuring is how quickly are we turning over and selling our inventory. We buy it and we sell it. We buy it and we sell it. That's like I said, Pawn Stars, right? Sometimes people will bring in an item on Pawn Stars. And Rick's like, hey, I really like this item, but this is going to be hard to sell. It's going to sit in the shop for 6 months before somebody buys it. That would have a bad inventory turnover ratio. It would be inefficient because it would sit on the shelf too long. It would be a really long time between when we bought it and when we sold it. So that's kind of the reverse of what we're saying here. An increasing inventory ratio says, hey, we're more quickly buying and then selling our items, our inventory. 7, when we look at this here, it says, hey, if the ending balance in accounts payable decreases from one period to the next, which of the following is true? So we have accounts payable. We know, hey, this is something we have to pay in the future. It's a liability. And with our liabilities, right, we have our beginning, plus we have our purchases on account, minus, when we repay our payables, right, we pay some of them off, gives us our ending. What they're saying here is, hey, the ending balance down here, it decreased from one period to the next. So basically, it went from, let's just say, for example, 10 to 6. What this means here is our cash payments to suppliers, this right here, our repayments, exceeded our purchases on account. So in other words, for it to go down, we have to have more on this side than we do over here. So that was 7. Let's look at 8 here. Which of the following regarding the lower of costs or NRV rule for inventory are true? Let's look at them. So the lower of costs or NRV is an example for historical costs. No, this is false. We said, right, this is an exception to the historical cost rule. It's not, examining it. It's not showing it. 2, it says when NRV or when the NRV of inventory drops below the cost shown on the financial records, net income is reduced. That's true, right? We said whenever we have a loss, when we do the revaluation, we do debit loss, credit inventory, 5 and 5. This loss is going to lower our net income, and it's going to lower our assets on our balance sheet. So that's why, both of these are true. So our net income is going to be reduced and our assets are going to be reduced. 9, it says, hey, which inventory method provides a better matching of current costs with sales revenue on the income statement? So it's basically saying, hey, what between FIFO, Lifo, and average cost, when we're picking one of those for cost of goods sold, which of them most closely aligns with the current costs of the inventory? Well, we know when we did these examples, right? Lifo is the last in. So let's just say we have day 1, day 2, and then day 3 for these. Day 3 is the most recent day right here. This is the closest to like the present day. So if we use Lifo and we start from the last in, our most recent purchases for cost of goods sold, if that's the case, then our cost of goods sold is going to more accurately reflect the current costs of what that inventory are. That's the idea with this, why it's Lifo. Lifo, last in, our most recent purchases, what we bought, the last thing we bought, that's the closest to what it's selling for right now, like if we were to rebuy it, because it's closest to present day. 10 here, I'll just say why this is false. Physical counts are not needed in a perpetual inventory system. because they're made on a transaction by transaction basis. So the perpetual inventory system, that's like the live stream inventory system. You check out, like, when you go to the checkout, it rings out, the inventory system is updated. Somebody might say, well, hey, if the computer's doing everything, we don't have to do a physical inventory count. Well, that kind of makes sense, but then if you think about it, just imagine somebody came in and stole something from your store. Came in and they stole, I don't know, what's an item, a t-shirt or something, right? Well, if all we're relying on is the computer system and somebody stole it, a t-shirt, our computer system never, they didn't check out when they stole the t-shirt, right? It wouldn't be reflected in our inventory. So even if we do the live stream, the perpetual inventory system, we still, to really have a good idea of what our inventory is, we still have to use a physical count at the end of the period. However, because we've been calculating cost of goods sold and inventory throughout, we'll have a pretty good idea of what it's going to be before the count. We're just kind of truing the count up. So let's look here at example 7.5. So what they want here is ending inventory and cost of goods sold for FIFO, LIFO, and average cost. And they're giving us some facts. So it looks like we have our beginning inventory at the beginning of the year. We have our ending inventory at the end of the year, and we made some purchases. The first thing is, like I said, step one, figure out the equation in unitary form. So we're dealing with inventory. We know from a unitary format, we started with 2,000 units, our beginning. We then bought 5,000. We then bought 3,000 more. And hey, at the end of the day here, we had 4,000 as our ending inventory. So what we got to do here from a unitary perspective is solve for our cost of goods sold. So what this means is it's going to be 6,000. So if you bought two, or if you had two, bought five, bought three, then you sold six, you'd end up with 4 at the end of the day. Step 2, once we know the unitary flow of it, we need to assign costs. And there's a couple different methods. So we got FIFO, LIFO, and average cost. What we're doing here is, like I said, so looks like we bought 2,000. So kind of have our beginning and our ending. Let's zoom out here just so we can, I'll get a bigger thickness. Let's do FIFO first. So when we're looking at the facts here, step 2, assign costs, we know we started with 2,000 at $5 each. So that's going to be 10,000. Then we bought 5,000 at $6 each. So that's 30,000. And then we bought 3,000 at $8 each. So that's 24,000. So this would be our goods available for sale. So that would be 10 plus 30, so that's 40, 64,000. So let's, given these facts, let's do FIFO. So we know it's our first in, or our first out. So we got first place, second place, third place. We start with our oldest inventory, our first place inventory, and we work our way down. That's FIFO. And what are we doing here? We said, hey, we sold 6,000 units. So 6,000 we sold. We have to now assign a cost, what we're doing, to these 6,000 we sold, and then assign a cost to the remaining 4,000 that were in ending inventory. So start with the oldest. We have 6,000 we got to cross off here. So let's do the first batch. Looks like we have 2,000 at $5 each. So that's going to be 10,000. We then have 4,000 at $6 each, which is going to be 24,000. What that means is we're going to have 34,000 costs of goods sold. So we took 2,000 from here and then 4,000 from the second place. That's cost of goods sold. Now we have to figure out our ending inventory. So if we took 4,000 from here, that means we have 1,000 left. So 1,000 left there at $6 per unit. So that's going to be 6,000. And then we have our third place remaining. 3,000 units left there at $8 each. 24,000. So that means 30,000 is our ending inventory. So our goods available for sale, 64,000. We're going to assign those, 34 to our cost of goods sold, and 30 to our ending inventory. So it's kind of like, remember we said we had our beginning plus our purchases, 2. Then that means we would have, 5 total. Some of these we assign to ending inventory. Some of these we assign to cost of goods sold. What we're doing is we're just giving these little squares, by using the prices, a unitary measure, like a monetary measure. So that's FIFO. I'm going to now do FIFO. Let's now do Lifo. So this is our last in is first out. So last in, third place, we're going to start with you. We got to take care of 6,000 units here. So we're going to have, when we do this, we're going to draw from our third place, last place first, 3,000 units at $8 a unit, gives us 24,000. We got to do 6,000, and we've taken care of 3, so that means we got to do 3,000 from our second place guys at $6 a pop. So that gives us 18,000. The idea here is our cost of goods sold under Lifo is going to be 42,000. Now what we could do is we could say, hey, well, we have this many left over here, this many left over here, and do similar to what we did and figure out our ending inventory. Alternatively, what we could do as a hack, an easy way for our ending inventory would be our goods available for sale minus our costs of goods sold, 42,000, gives us 22,000 for our ending inventory. So you could do the, count what's left and cross multiply. That's like one way of doing it. An easier way of doing it is say, hey, we know we have to assign $64,000 total. We just assigned 42,000 to cost of goods sold. We know that that means there must be 22,000 that go to ending inventory. Two ways you can skin a cat. If it makes more sense to you to do this way, where you kind of literally work your way through and see what's left over, it's no big deal. The idea, though, is what you have to be careful of on the exam, and where I could trick you, is I could give you these facts and I could say, hey, use FIFO, but please tell me ending inventory for FIFO. So you may go and do this and work your way first in, first out, and solve for cost of goods sold, where I really am asking for ending inventory. Or alternatively, like I said, I could say, Lifo, give me cost of goods sold. The idea is you need to, not just be able to say FIFO, work from the top down and get this one number. You have to understand that I could ask you a variety of ways what's going on. So it's a little bit, you just have to be familiar with the terms and kind of the entire package of how this works. So that was Lifo. The last one here is average cost. So when we do this average cost, what we said is, hey, we know our goods available for sale are 64,000. We also know we have 10,000 units. How did we get that? Well, it would be 2 plus 5 plus 3. That's where we got the 10,000. So that means, hey, on average, out of the 10,000 units we bought, each one cost us $6.40. So for purposes of cost of goods sold, we know, hey, we have 6,000 we have to assign a cost to, times 640. In that case, it means it's going to be 38,400 for cost of goods sold. We take 64,000 minus 38,400. That means our ending inventory is going to be 25,600. Or alternatively, you could take 4,000 units. So we had 10,000 here. We sold 6, 4,000 times the 640. That's the idea, is we're allocating our goods available to sale to cost of goods sold into ending inventory. So that was 7.5. Like I said, you're going to have to do similar problems to this. Now we're going to do problem 7.1. A lot of homework pages here. Lucky you guys only get 6 or 7 questions, right? I got to know all of this stuff. So, give me a second. Let me zoom in on this. So it looks like they're giving us some information about Travis Company. We know in this class, right, we like the McDonald's hamburger, so we'll just call it the Travis Scott Company. Have some fun, right? Call it, what's the other one? The JV Balvin? Is that the other one? J Balvin, okay. Mixing up JB. I don't know who he is. I heard somebody else was going for McDonald's now like all celebrities have their own McDonald's meal, like whether they're official or not, like they're like post online what they order at McDonald's. Um, I don't have a meal. I guess I'll have to create one for like to be the SUNY Brockport professor meal. I can tell the Brockport McDonald's people like, hey, just say Professor Donnelly when you drive up, and they'll know. That would be kind of cool. I hope my legacy here isn't like the McDonald's guy, right? I don't want to be like remembered as the McDonald's guy. But like I said, we're not allowed to have fun in accounting, right? That's not that would be too much. What they're telling us right here is, so let's imagine we have the Travis Scott Company, and they get some new hires at the Travis Scott Company, and they're saying, hey, new hires, we have a job for you. Your job is to count the inventory we have here, the number of cheeseburgers or ketchup, whatever the case is. Go back there and count how much we have. So we sent our new employees into the back room, and we said, count our inventory. They came back to us, the new employees, they said, hey, we have $80,000 worth of Travis Scott burgers back there. It's a lot of cheeseburgers, right? A lot of bacon. I told you guys I didn't know that, like, I truly thought the Travis Scott burger was like a limited time thing. I didn't think you could order it like outside of the promotionary window. So like went to McDonald's when I got you guys the burger, and I was like begging the person, like, I know the Travis Scott window has ended. Can you please, I promised them a Travis Scott burger. And she was like, yeah, you just order like a quarter pounder, like plain with bacon. Like you get that at any time. It exists outside of the promotionary period. So luckily, it lives on. It didn't go away. But looks like we got $80,000. What this example, this is, kind of the Marty McFly. It's doing the blast from the past. This is dealing with, let me erase that, get bigger. Some last week terms we learned. So this is dealing with, oh, that's too thick. That's really too thick, geez. Let me go with that guy. So we have FOB shipping point, and we have FOB destination. What does this mean? From a seller's point of view, what this means is at FOB shipping point, we sell something from a distance. We got the business right here, right? They go to the post office and say, here, we ship the goods. You sell something on eBay, you drop it off, and it goes to the post office. At that point in time, title changes hand. So now the person you sold it to on eBay, you dropped it off, they own it, and you will credit revenue. Under FOB destination, let's say we're selling something on eBay, right? Only when the post office employee, so, we have, I guess, hair, and the post office employee has his post office hat, right? Give him the hat. When he puts the package on their doorstep, right, and it gets delivered, only then does title change hand, do they own it, and we credit revenue. So that's, part of what's going on here is we need to remember these facts, right? So what they're saying to us, they're going to give us some facts. I'm going to read them out loud because it might be hard for you guys to read them, but for me to do the chart on this, we have to, have sufficient room over here. So essentially what's going on is they said, hey, we had ending inventory of $80,000. But part of the problem is these new employees, they're not the greatest. They don't know all the rules of accounting. like this FOB shipping point and FOB destination. So when they counted this, they may have counted some stuff they shouldn't have counted, and they may have excluded some stuff they should have counted. And they also, we just said, hey, go in the back room and literally just count what's there. They don't know about stuff that may have, been shipped to us and we own it. They only are literally seeing what's there. So what we need to do is kind of work through each of these statements and help these new employees correct our inventory so we have the right balance on account. So let's look at A here. So it says, hey, goods costing $900 were being used by a customer on a trial basis. Whoops. And were excluded from the inventory count. So what happens is, hey, we, let's just say we're Home Depot or Lowe's. We let somebody go try one of our items, one of our customers. Like, here, try this snow shovel for a week. Come back, tell us if you want to buy 100 units or something. Well, what happens is we send our employees back there. They don't see the snow shovel we lent out on trial, on a trial basis, so they didn't count it. We still own that snow shovel, right? It's out to our customer who's using it. So what that means is they didn't see it, but we still own it, so we got to add the $900 to our inventory. So that was A. Essentially, they went back, literally counted what was there. They didn't see it. They didn't know about this. We know about it. Our customer's trying it out. We need to add it to our inventory. We still own that. We own it, but it's not physically at this location. So with this one, let's look at B here. Goods in transit, so we're dealing with shipping here, on December 31st of the current year from a supplier with terms FOB destination cost $900. Because these goods had not yet arrived, they were excluded from a physical inventory count. So we're dealing with FOB destination. The idea here is, hey, we bought something, we're waiting for it to come. It hasn't come yet. It's not physically here. Title only changes hands, and it's only our inventory when it gets here. It hasn't gotten here yet. They didn't count it. This is okay. So in other words, they did the right thing here. This is FOB destination. We ordered it. It's kind of like, right, you order something on Amazon, a toothbrush. It's not yours until you get it, until it comes to your house. So we sent them, to the back room. We ordered more inventory. It's not here yet. The terms of the agreement say we don't own it till it gets here. So they did the right thing. Let's look at C. On December 31st of the current year, goods in transit to customers, so things we're selling to our customers, which are FOB shipping point, amounted to $1,700. Expected delivery January 10th of next year. Because the goods had been shipped, they were excluded from the physical inventory account. So the idea here is we sold something on eBay, we shipped it, our terms were FOB shipping point. Once we ship it, we take it to the post office. It's not ours, it's the other guys. We need to exclude it from our inventory. They, in fact, when they went back there, it wasn't there. They didn't count it, so they excluded it. They did the right thing. Let's look at D. On December 28th of the current year, a customer purchased goods for cash amounting to $26.50 and left them for pickup on January 3rd of the next year. Travis Scott Company had paid $17.50 for the goods and, because they were on hand, included the latter in amount in a physical inventory account. What does this mean? So, right, you go to Home Depot or something, you buy a John Deere tractor, and you show up with your, Toyota Corolla. There's no way, right, when you buy that you're going to be able to take that thing home in your Corolla, right? You're not going to fit a tractor in a regular car. It's just not happening. So what you do is you say, oh, hey, Home Depot, can you hold on to this tractor? And I'm going to be back in like 3 days from now with, I'm going to rent a pickup truck and then I'll take it then. What happened here is, in the scenario, that tractor was sitting when we sent our new employees in the back room to count the inventory. They counted that tractor. They said, hey, it's here, we're going to count it. But they didn't know that the customer already purchased it. The customer owns this thing. So even though they counted it, they shouldn't have counted it. It's not ours anymore. It's sold to the customer. We're just holding it for the customer until they come back to pick it up with their pickup truck. So that's the idea for D. Let's look at E. So on the date of the inventory account, when we sent those employees back there, the company received notice from a supplier that goods ordered earlier at a cost of $35.50 had been delivered to the transportation company on December 27th of the current year. So it looks like we bought something from somebody off eBay. They shipped it, right? We got the notice. It has the tracking number. We can see that they shipped it. And it looks like the terms here were FOB shipping point. Because the shipment had not yet arrived by December 31st, it was excluded. So here's the deal. We bought something. The terms of that agreement were FOB shipping point. We see on our eBay account that the guy shipped it. Once he ships it, it's ours. We haven't actually received it yet. We're still waiting to get it. We're tracking the shipping, but it is ours. We sent our guys back there to do the count. It wasn't there yet. We haven't received it, so they didn't count it. However, we should count it. We own it, right? The guy shipped it. When he ships it, it's ours. Needs to be added to inventory. So that's E. F. Speaking of shipping, right? Amazon, 2-day shipping. It never comes, right? It's always on day 2, and it's always at like 9 o'clock on day 2, right? It never comes like, at the earlier, and you're sitting around like waiting for it. It's like 4 o'clock, 5 o'clock. The Amazon people don't work within like normal post office hour thing. Sometimes you're like, this is not coming today. There's no way they're making it in the 2-day window. And then like 11 o'clock at night, some random guy drops a package off at your house. That's right. They get it. They squeeze it in. They fit it. But you're just like, there's no way it's coming. Walmart, right? They're moving towards a shipping thing, right? I think they have something where you spend like $15 or something. And if you buy groceries, they'll deliver it to you. I've almost considered doing this just because it's such a headache going into Walmart, like fighting the battle of walking through the giant store and checking out and parking. You can only go in the one door, right? It's like it would be too great if you could go in both doors at Walmart. So I've considered that. We'll see going forward. Like I said, we got to have some fun in here, right? We're talking about like shipping point and things like that and subscriptions. The other thing I was telling somebody before class, right? Personal financial planning. It's like, in our society, it's death by 1,000 cuts. So what that means is when you guys like get out there and you graduate, you're going to have your rent, you're going to have your car payment, your Netflix, your phone, your whatever other subscriptions, right? Disney, Hulu Plus, ESPN Plus. Everybody wants everybody's shaking you down for $5 or $10. It's death by 1,000 cuts. When you get your paycheck, that's going to go away. Nothing in itself, these subscription models, is that expensive. But when you add them all up, you're going to have little money left. So just be cognizant. Like I said, we try to do some like real world practical personal financial planning when it's appropriate. So let's get back to the facts here. We got two things left. Let's look at F. On December 31st of the current year, the company shipped $700 worth of goods to a customer, FOB Destination. So we shipped stuff, we sold it on eBay, we shipped it. Only when it reaches the guy do we have our revenue. The goods are expected to arrive at their destination no earlier than January 8th of the next year. Because the goods were not on hand, they were not included in the physical inventory account. So we know title only changes hands here when the guy we ship it to receives it. They haven't received it yet. However, it's not sitting in our back room because it's shipped. So what that means is when we send our people in there to go count it, they didn't see it. It's in the mail, it's being shipped, but it hasn't reached the people yet. Because it hasn't reached the people yet, it's still ours. We still own it. So what we got to do is increase our inventory by $700. So that's F. G here, this is like a mammoth. They love to put like huge paragraphs in. So it looks like one of the items sold by the company has such a low volume that management planned to drop it last year. To induce Travis Scott Company to continue carrying the item, the manufacturer supplier provided the item on a consignment basis. This means that the manufacturer supplier retains ownership of the item. In Travis Scott Company, the consignee has no responsibility to pay for the items until they are sold to a customer. Each month, Travis Scott Company sends a report to the manufacturer on the number sold and remits cash for the costs. At the end of December of the current year, Travis Scott Company had 6 of these items on hand. Therefore, they were included in the physical inventory count at $950 each. That's a mouthful. So the bottom line here is we had at the end of the year 6 that cost $950. So that's $5,700 that we had on there. So let's back up here, right? If we're talking about Pawn Stars, right? We like Pawn Stars. I'm just going to presume you guys like Pawn Stars. I think it's kind of, has jumped the shark, right? It's been on pretty long now. There's probably some new show on History Channel that has nothing to do with history. But when you walk into the Pawn Stars shop, there's a couple different things you can do. So you have your rare vintage item. You can, one, sell it to them, right? You could say, hey, I want to sell this, and they'll give you like 20% of what it's worth. That's one thing you can do. Another thing you can do when you go into a pawn shop is you could say, hey, here's my fancy guitar. Can you please, can I get a loan for this? So give me $100. You can hold the guitar as collateral. If I don't pay, the guitar is yours. The third thing you can do when you walk in, you can say, hey, Rick, I want to co-sign this item. So what this means is I still own it, the guitar, but I give it to you to just put it in your store, and then you sell it. When you sell it, you can get like 10% of the sales price. So I'll be the co-signor, I'll sign off on this, you can be the co-signee. I still own it, but you're just selling it. How that relates to this fact pattern here is we had a similar thing that went on. So imagine we send Chumley, right, to the back of the store. He sees this guitar. He counts it in the inventory. He says, hey, we have this guitar. But guess what? We don't own it. The people who came into the pawn shop who gave us this guitar on a consignment basis, they're the owners of it. So what we got to do for G is here, when we look at it, is back out the $5,700. That's the story here with G. If you're wondering, like, what is all of this going on? We don't own it. Even though it's here, it's not ours. It's the person, the co-signers who own it. So the idea is when you take your ending inventory, per the Chumley count, right? We sent Chumley back there to do this. He screwed up. He's not the smartest, right? We can't count on Chum, right? And then we made all of our corrections. So we add 900 minus 1750 plus 3550 plus 700. The end of the day, our corrected inventory is going to be 77,700. So that's when you just do the math when you work your way down. So that was problem 7.1. You're going to have a similar example to that in the homework. The last one here is 7.2. So this is just another average cost, first in, first out, last in, first out. Let's look at it here. So what they want from us is our ending inventory, our cost of goods sold, our goods available for sale, and they want us to do that under the average cost method, Fifo, Lifo, and specific ID. So we got average cost, Fifo, got Lifo, and specific ID. So looks like Kirkland uses a periodic inventory system at the end of the annual accounting period. So at the end of the year, December 31st. Looks like the accounting records for the inventory show the following. So when we look at this, our beginning inventory on 1/1. Looks like we had 400 units that cost us $3 each. So that's $1,200 total. Looks like we had some transactions that happened during the year. So on January 30th, we made a purchase, and it looks like we bought 300 units that cost us $3.40 each. So we're going to have a total cost of $10.20. And it looks like on May 1st, we had our second purchase. This was 460 units that cost us $4 a pop, equals $18.40 total cost. So all in, looks like we're all in for $40.60 when we add those up. And it looks like the total number of units in this case would be 1160. And when we look at this here, when we're doing our kind of step one, when we work our way through here, our ending inventory, so if we check it out, so our inventory, so this right here is our goods available for sale. So in this case, how we would get our ending inventory, we would take our goods available for sale minus, in this case, look at this here. This, okay. Let's back up here for a second. This is not given the best way of explaining it. The idea here is our ending inventory is going to be 300 units. We'll figure out how we got that in a minute here. Let's start with FIFO, because we know that's the easiest. So FIFO, right? They're asking for two things here. And what we know is we're trying to get and distribute our goods available for sale. We're trying to distribute it to our ending inventory. As well to our cost of goods sold. Now, in this case, given these facts, FIFO is our first in, is our first out. So in this case, our first in inventory, we have to, let me just figure this out here for a second, how many we sold. Our ending inventory, pull up the calculator. Our ending inventory is 300. So we got 1160 is our goods available for sale. And our ending inventory is 300 units. That means we must have sold 860 units, right? So our cost of goods sold here, we have to, with FIFO, take care of 860 units we sold. We need to assign a cost to those. So FIFO, our first in, our beginning, we have to do 860 units. So we would do, start from the top, 400 of those units that cost us $3 each. So that's 1,200. Then we would have, so take that from there, and we'd have 300 that cost us $340 each. Then we would have, so that's 700. We got to take care of 860. So that means we got 160 that we got to draw from here at $4. So let's pull out the calculator. So we got 300, bless you, at 340. So that would be 1020. We got 160 at 4. So that's 640. Get this out of the way here. The idea here is our cost of goods sold under FIFO is going to be $28.60, cost of goods sold. So let me do a quick check on this here. 4060 minus 2860. So we could, like I said, you could calculate ending inventory by saying, hey, we started up here, worked our way down, what's left over? Or alternatively, we could say, hey, 4060 minus cost of goods sold, our ending inventory is going to be 1,200. So that's FIFO. Let's do Lifo. So with Lifo, we know it's our last in is our first out. We have 860 units that we sold that we have to account for. So what we're going to do here in this case for Lifo, 100 units, 300, 460. Ending inventory, cost of goods sold. So we got 860 that we're taking care of. So we start at the bottom, Lifo, last place, third place, work our way up. We got to take care of 860. So we're going to have 460 at $4. Then we're going to have 300 at $3.40. Then we're going to have 100 at $3. So that's 300. Let's do the math on these guys. So it's 300 times 340. So 1020. And 460 times 4 gives you 1840. Sum all of those together. The idea with this is Lifo, the cost of goods sold here. Let's add them up. So we got 1840 plus 1020 plus 300. That equals 3160 is our cost of goods sold. So again, we could say, hey, we started with our last in, we worked our way up. What's left over? Let's manually look at each of those. Or alternatively, what we could do is we could take our goods available for sale, 4060, minus our cost of goods sold of 3160. That would give us an ending inventory of 900 under Lifo. So we did FIFO, we did Lifo. In this case, let's do, so we know per the facts, right, that we sold here 860. So 860 we sold. And it looks like if we sold 860, then we had 300 in ending inventory. This is units. So in other words, we had 1160, our goods available for sale, we sold 860, meaning we had 300 left over in our ending inventory. So average costs, what this says is, hey, on average, what did each one of these items we bought cost us? So what we're going to do here is we're going to take, in this case, let's go back up here to look at the facts. We said, hey, we started with 400 at $3, and we bought 300 more at 340, bought 460 more at 4, so that gives us 1200, 1120, 1840. All in, we're at 4060, so that's our total cost, right? Going back, looking at the facts here. So we started with 400, purchased 300, purchased 460 more. We're at 1160 in total units. So this is total units over our total costs. So what that says is, hey, on average, our average cost per unit was $3.50 per unit. And again, what are we doing here? We're saying, just to kind of level set, so we have, and what we've been doing in all of these is we have our beginning. These are just units, right? So step one is units plus our purchases. So let's just say we bought 2 more. This equals our goods available for sale. So that would be 5. What we do is we then say, hey, at the end of the day, so it's the end of the period, right? We have 2 when we do our physical inventory count, right? We said under the, both of the manufacturer and merchandise are at the end of the period, right? They're going to do a physical inventory count. So that's this guy right here, ending inventory. Well, we know if we have 2 left over, and at our max capacity we had 5, that means we must have sold 3. But that's just step 1 that we did. Step 2 is each of these items in ending inventory and cost of goods sold, right? When you do the inventory equation, you can do it, with the actual raw units to help break this out and solve for cost of goods sold. But at the end of the day, what ultimately goes on the financial statements is a dollar amount, right? You don't put in here debit inventory, 2 blocks, right? Never seen a journal entry like that, right? Where you just put in a unit. You'd say, well, hey, if these 2 each cost $5 each, we debit inventory $10. So that's what step 2 is, saying, hey, what we have left here in our ending inventory and our cost of goods sold, we have to not only break that out, we need to assign a cost to it. That's where we have Fifo, Lifo, weighted average, and specific ID. Going back to where we were, and like I said, I'm going to wrap up when we finish this, and now record after the fact the last part with specific ID, and I'll get this uploaded for you guys. Like I said, I do want you to go home and watch the debate. We said, hey, our total cost for all of these was $40.60 for 1160 units. That's $3.50 per unit on average. We know we sold $8.60. So for purposes of calculating cost of goods sold under the average cost method, so $8.60 times $3.50 per unit. In that way, so let's do the math here. So 860 times 350, that's going to be 3010. for our cost of goods sold. So we could take, again, one way we could do this is we could take the 4060 up here minus the cost of goods sold to get us our ending inventory. Or alternatively, we could say, hey, we had 300 in ending inventory with, on average, 350 per unit. So let's see here, 300 times 350, that equals 1,050 for our ending inventory for average cost. Let's get this up here. Okay, so that was average cost, correct? One of the things I want to backtrack here and just, we didn't look at this specifically, but if you couldn't figure it out, it's not that hard. I just wanted to show you guys. So remember we always said step one was the units, right? So it looks like we started with 400. We then bought 300. We then bought 460. And then this is where looks like we sold 160 and we sold 700. That's where we get, in this case, our ending inventory of 300. And that's where we get our cost of goods sold, or our unitary, how many we sold, are 860 in units. Now the last item we have to do here, so right, we did, in the order we did them was a little off, but it's okay. FIFO, we did Lifo, we did average cost. Now we have specific ID. This one's a little bit trickier, so we have to work our way through this, given the facts. So let's see here. So when we look at this, it says specific ID, assume that the first sale was selected 2/5 from the beginning inventory. So 2/5 from beginning and 3/5 from the purchase of January 30th. So actually, let's reverse this just to make it easier. So first sale, we had two sales up there. The first one, 2/5 from beginning, 3/5 from purchase of January 30th. Second sale was selected from the remainder of beginning, what was left over after the first sale, and then the balance from the purchase on May 1st. So this one's pretty complicated. You're not going to see it on the exam this in depth, but I'm going to rewrite it all out just so we can see how this works. And let me pause here to plug in my laptop. So rewriting the facts on 1/1, we have our beginning inventory. So we have our units, we have our cost per unit, and we have our total cost. So looks like we got 400, and on 130 we have purchase 1 for 300. Then on 5/1 we have purchase 2 for 460. And then going back up, it looks like our first sale, so sale 1, we sold 160 units. sale 2. Let's go up and check that out. We sold 700 units. And just to mirror the highlighting, it looks like we used yellow and blue. So, got yellow, 160, blue, 700. And what they're saying here, right, we look at it, it looks like, let's go back up and check this out. So the first sale, 2/5 of that sale, so 2/5 of the 160 units came from beginning inventory. So we're doing sale 1, 2/5 came from beginning, and then 3/5 came from purchase on 1/30. So what that means is if we were to take 2/5 times 160, we would get 64 units. If we took 3/5 times 160, we would get 96 units. So that's 160 units from sale 1. So that's just level setting with what we're doing. So what that means is, so hey, from that first sale, we took 64 units, which decreases this then down to 336, the adjusted, so 400 minus 64. And then from the 130 sale, it looks like we took 96 units, which means we're left here with 204 units. 204 units. So that's after sale 1. Now for sale 2, which was 700 units, sale 2, what they're saying is it was selected from the remainder of beginning, so what was left over here, remainder of beginning, so 336, so that's the remainder. So that means 700 minus 336, 364 left over. And they said, hey, from the 364, it looks like the remainder from beginning inventory with the balance, so what was left over from the purchase of May 1st. So what that means is this guy, we took 336, this was adjusted, this is now all taken care of. And then we took 364 from 460. Looks like that will get us, let's see here, 96 units here. So what we do here is, instead of directly solving for cost of goods sold, let's do ending inventory first. So we know at the end of the day, ending inventory, we have, when we look at it, 0 units that cost us $3. We have 204 units that cost us $340. And then we have 96 units that cost us $4. The idea, the total of all of that, 204 times 340, 96 times 400, it's going to be ending inventory is 1,077 and 66 cents. What we then do to solve for cost of goods sold is we take our 4060, the dollar amount, our goods available for sale, minus our ending inventory of 1,077.60. That will get us, for our cost of goods sold, 29, let me move this out of the way. $29.82.40 for cost of goods sold. Oh. So ending inventory and cost of goods sold. Like I said, on the exam, it won't be that hard. This is like actually a pretty difficult question. You're going to need to, if you're watching this, I'm sure you're probably jammed up on this. Don't worry about this difficulty for the exam, but I hope this helps you on the homework. So thank you very much. We'll see you next week.